bigger bubble.
I see. Ken, when you're writing, I don't know, you've written your final chapter now, so where you put your finger on it, where do you put your finger?
Yeah, I mean, I put more of the blame on the U.S. and the policy response. We always have a recession following boom. So we had a huge boom. You have a recession, you have bankruptcies, you have defaults. That's all very normal in the cycle. But I think this one was really aggravated by the fact that the United States was ground zero, and the United States is the reserve currency, the center of the financial system. And, you know, you can point at these individual problems, the deregulation of the subprime mortgage market, the mind-numbingly bad decision to allow investment banks to leverage 3 times as much as they were before in 2004, a whole series of poor decisions. But at the end of it, I think it really was occurring in this environment of incredible borrowing by the United States. It was borrowing 2/3 of the world's net savings year after year. And the hubris, we saw housing prices rise and equity prices rise, and many people warned about this. I certainly started warning about it in 2001, and certainly when I was at the IMF. And I won't say that I saw the contours or could have begun to give the speech Nouriel just did about what was exactly wrong, but I'd certainly seen over history, and we did studies, that when housing prices are shooting up and there's huge borrowing and a country's borrowing a lot, all the red lights are blinking and it ends in tears. And yet, among U.S. officials, there was utter denial about this. And Greenspan, I think, carried the most gravitas. The Treasury secretaries were saying the same thing, but nobody was paying attention. But Greenspan carried the most gravitas about it. And I had small debates with him, and I say small because I was debating and he wasn't. But I think
it was actually a one-sided debate.
I think actually I had the privilege of speaking to this group, I think in 2004 maybe, the first time after I just left the fund, and I related then a story that had just happened where I'd spoken right after Greenspan at the Cato Institute to a room, you know, like this. And he had just finished saying, everything's fine, there's financial globalization, housing prices are okay because our financial markets are deeper and everything's great. And I think the organizers knew I didn't have that view. And I get up, and as I related, you know, 3/4 of the room left before I could say anything, and there was a lot of noise with the cameras closing up and everything. But there were, you know, there were certainly many of us. And I think I give Nouriel a lot of credit because I was saying this, but I don't, you know, reporters would ask me, is this going to be like Argentina? Is this going to be an emerging market? And I didn't want to seem hysterical. So I said, no, I'm very concerned about, you know, the derivatives and stuff. But I think Nouriel actually very early on had the insight, you know what, it could be like an emerging market. Yeah. And I think we're still playing that out.
Ken, having dealt...
Well, okay, just to kind of jump in for a second here. 2 or 3 quick points. One is that, yes, the U.S. was ground zero. Yes, the Fed contributed by keeping interest rates too low for too long. And I agree with all that. However, if you remember, in the run-up to this, everybody was complaining, for example, that Chinese interest rates way too low. Chinese money supply growth way too fast. And it wasn't just China, all emerging markets. To me, this was arguably the biggest global credit bubble. U.S. played a big role. No debate about that. But it was much bigger than just the U.S. So I think just to blame the U.S., I'm not suggesting either of you is doing that, is maybe a little sort of simplistic. The other question here is, would things have been this bad if we didn't let Lehman Brothers go? If you really look at the data, starting about the middle of September on, it's almost like everything fell off a cliff. What happened when we let Lehman go, and the very bad sort of 2 or 3 weeks after that, was the whole system froze up. Trade finance froze up. You know, it just, everything kind of froze up. And so one has to wonder whether or not things would have been anywhere near as bad. I mean, I'm not saying we would have avoided a recession. No. We had a recession in our forecast. But would things have been, would they have been as bad if we had not let Lehman Brothers go?
Well, what do you guys think?
My view of it is that, you know, emphasizing Lehman is a little bit incorrect. Yeah, certainly the collapse of Lehman exacerbated the liquidity and credit crunch, but the liquidity and credit crunch started the year before. The U.S. recession started in December of 2007, when Lehman occurred 9 months later. And by the time Lehman went bust, if you remember, Fannie and Freddie were bust and being taken over. Merrill and the demise of the broker-dealers would have occurred regardless of. WAMU and Wachovia, because of their exposure to real estate, were bust. And, NAIG was bust as well. So if you had bailed out Lehman, you had to bail out Merrill, you had to bail out AIG, you had to bail out WAMU, you had to bail out Wachovia. And let's not forget that there was an entire financial system, banks, non-bank mortgage lenders, sieves and conduits, broker-dealers, hedge funds, and others that were highly leveraged. I mean, we've seen the demise of the shadow banking system, a system of institutions look like banks because they borrow short, they leverage and they lend long, but unlike banks, they did not have access to either deposit insurance or the lend last resort support of the Fed, and therefore, once this liquidity run occurred, there was no way to rescue them. I mean, it's really a collapse of the system that occurred well before Lehman and would have occurred regardless of Lehman.
Yeah, can I just, sorry, quick thing. If you look at risk spreads, like the TED spread, which for those of you not aware of, it's the difference between the LIBOR, the 3-month, let's say just look at the 3-month LIBOR, London Interbank Overnight Rate, and the Treasury bill rate. They shot up, basically, right after the Lehman Brothers collapse. Absolutely skyrocketed, suggesting what? A huge amount of stress in the financial system. They have since come down quite dramatically, thanks in part to, the various bank rescue programs and so forth. But you're right that there was a sort of a slow meltdown going on, no debate about that, but it didn't show up in the kind of financial stress that occurred right after Lehman went down.
Right. Well, let me turn to Ken, but just to observe that it does seem that every financial crisis, I don't know if you find this, often seems to have its symbolic bankruptcy. That Credit Anstalt is a famous bankruptcy in July or August of 1931. Lehman is the one that everybody's going to remember and argue for a long time about, but what do you think?
I think there's the popular misconception, and I think the vast majority of people involved in the financial sector believe there was a catastrophic mistake made with Lehman and this wouldn't have happened. That's an utter delusion. This was a volcano ready to blow. The financial system is way over-bloated. You can look at figures about the size of the financial sector in U.S. GDP having doubled over a relatively short period. The last few years, they were taking up, it depends on how you measure it, but 20 to 30% of corporate profits. This was...
historically, it was what?
Historically, 5% or 6%. And this was something that had to be consolidated. And there was no way for the consolidation to take place without some big players going under. I think at that moment where Lehman was about to go under, people said, well, why don't you do what they did with the first one, Bear Stearns, which was maybe the 5th largest investment bank. They let J.P. Morgan buy and made a gigantic subsidy. Why not just do that with Lehman? Well, the answer was they were staring at Citi, at Merrill, at AIG. The whole system was collapsing. And if it wasn't Lehman, it was going to be somebody else. So the market somehow had this delusion that the U.S. taxpayer would come in and buy these, trillions of dollars in the financial system, which just wasn't in the cards. Now, they did mishandle Lehman, and I think it's relevant going forward. They had thought, so Lehman had this big, complicated structure to its books, had a lot of assets, a lot of liabilities that on paper were offsetting, but they didn't offset them. They were told to offset them, but they didn't. It was a negotiating strategy on the part of Dick Fuld, I think, to say, well, I know I said I was going to net my books, but guess what? I didn't. And it's going to cost you $50 billion if you bail me out and $300 or $400 billion if you don't, so why don't you bail me out? And the Treasury Secretary and the head of the Federal Reserve were furious, but they should have come in and paid that few $100 billion or whatever it took to net out the books. That was certainly a mistake.